Hi, my name is Neha, nay like a horse, haha that's funny, and welcome back to my channel. So, I have a lot of friends who don't like learning about finance, and that's just because the type of content just doesn't appeal to them. I get it. So that's why today we're here, just on my bed, keeping it chill, and we'll have a little talk as to how you can understand financial statements. But before we start chatting, make sure you hit subscribe, hit the bell, and obliterate the like button. If you do all that, I won't sing a little jingle in this video. You're welcome. My little gift to you. So, why would you even care about financial statements when you could easily just go buy a random stock and it could make you a bunch of money? Well, that could happen, but what could also happen is a company has an amazing reputation, blows up on TikTok, and so you go and purchase the stock, and then all of a sudden goes bankrupt. If you had taken a little extra time to look at the financial statements, then you could have potentially seen whether or not the company was about to crash. So that's why it's important to have a little basic understanding as to what the numbers are telling you. There are 5 financial statements. Balance sheet, it's where you'll get a very holistic view. Income statement, you'll find your revenue and expenses. You'll have your statement of cash flows. That's where you see where cash is coming from and going to. Your statement of stockholders' equity, that's where you can find your earnings. And lastly, the notes. That's where you find other key important information, like any litigations they may have right now or how they're getting to some of their numbers. Today, we're going to keep it simple, get straight to the point, and cover 3 basic ways that you can interpret the balance sheet. Understanding these financial statements can take some practice, but once you get a hang of it, it's super easy. There do be a whole degree as to how to create and understand these statements. Lucky for you, I happen to be pursuing that degree. So if you'd like to learn more about each of them in detail, I'm happy to make a video for you in the future. But for today, let's focus on the balance sheet. So, the 3 ratios we're going to be talking about are the current ratio, the debt to equity ratio, and the debt ratio. No, I didn't say the same thing twice. They're all very easy to understand, I promise. We'll break it down. First off, the current ratio. All you're gonna do is use little 3rd grade math. That's all you need for any of these. You're gonna go to the balance sheet, and right where it says current assets, you're gonna take that number and divide it by the current liabilities number. And with a little bit of division, a little bit of magic, all of a sudden you have your current ratio. Instant genius. So now that you have this magical number, what does it tell you? Well, the current ratio will tell you if the company has enough assets, like cash and inventory, to cover its short-term liabilities. This gives you an understanding as to how it'll do in the short term. Will it die in an instant, or will it survive for a little bit? Ideally, you want this number to be on the higher end. Greater than 1, definitely greater than 0. There could be a few reasons as to why it's a little under 1, but ideally you want it higher. But if it's below 0, run for the hills. So your debt to equity ratio, you're going to take your total liabilities, total, current and long term, and divide it by your stockholders' equity or your earnings. That's your assets minus your liabilities. Or if you just look on the balance sheet, it does it for you. It's a beautiful thing. So what does this number tell you? This number tells you whether the company has a lot of debt in comparison to its earnings. Does it have a bunch of loans or money it owes people? You want this number to be on the lower side. And for some industries, it may be on the higher side. If it's greater than 2, it's considered incredibly risky. 0 to 1, relatively safe. But like I mentioned, some industries such as banking, you'll see them on the higher end. Similar to the debt to equity ratio is your debt ratio. For that one, you're going to take your total liabilities again, but this time you're going to divide it by your total assets. This will make sure the company has enough stuff it owns to cover what it owes. It's very similar to your debt to equity, but instead of comparing the debt, what it owes, to its earnings, it's comparing it to what the company has, what it owns. But where you want this number is similar. You want it on the low end, between 0 and 1, but for some industries, it could be higher. And those are your 3 ratios that I'm sharing with you today. Super easy, and now you're an instant genius. And because you've stuck with me so far, I'm going to share how you can find painfully obvious ways the company is going under. And that is through the beauty of a 10 and an 8K. 10 and 8Ks are not individual financial statements, but they are incredibly important reports that you as an investor should know about. Literally spoon feeds you the information. Beautiful. A 10K is a very comprehensive report. It includes the financial statements and any other important information any investor should know. An 8K is where you'll find important changes within the company, change in executives, or any bankruptcies. It'll tell you straight up whether anyone has any going concerns about the company, whether they think it's about to crash. Straight up. The quick little Google search, you'll be able to find any 10 and 8K for any public company because legally they are required to file it with the SEC. Now that you know all of this knowledge, you have so much power and you're an instant genius. Now the next time you think about or even look at a financial statement, you can feel like a boss booty. Bitch. Yes, ma'am. Yes, sir. So hopefully you have more confidence now to go and take those 10 extra minutes to do a little additional research, because those 10 minutes could potentially save you from making an investment you're not comfortable making. If you have any questions, like always, feel free to leave a comment down below and I'll be happy to respond. Make sure, before you head out, subscribe if you haven't already done so, hit the little bell, and hit the like button. Nay, obliterate the like button. I mean, I didn't sing once this whole video. All I'm saying. You're welcome. You got this. You're a genius. Until next time, I'll see you later, my dudes.